Alright, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And today's video is my third installment of my live trading video series. And today's date is Friday, May 14th. And as always, quickly before we get started here, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, let's get started here. And this has definitely been a pretty crazy week, and I'll talk about that here in a second. But first, let's give you a portfolio update. And so as you can see down here, I currently have on 5 different positions, some of which are new, and some I've had on before. And so specifically in my last live trading video a week ago, I also had on a Peloton Strangle, which I did take off this week for profits. If you recall from last week, Peloton did have earnings. Let's look at the Peloton chart here. Right, you can see the earnings announcement right here on May 6th, and this turned out to be one of my best trades ever. After the earnings figures came out, the stock pretty much went nowhere, and also implied volatility absolutely collapsed. Right, this was the implied volatility leading up to the earnings announcement, and then once those figures came out, boom. It got absolutely annihilated. And so this kind of thing is exactly what I'm looking for as an option seller. So that's why after having that position on only for 2 days, I was able to take it off for a nice profit. And so in place of my Peloton Strangle, I did add 2 more Strangles. One in X, which is US Steel, and the other in FCX, which is a company that engages in the mining of copper, gold, and a few other elements. And both of these 2 stocks this week were showing very high implied volatility, probably both because of the market sell-off we saw this week, which therefore caused implied volatility to pretty much skyrocket across the board. And also there are a lot of inflation fears right now, right? Because if you look at some of the markets for some basic commodities and some basic materials, like steel, like copper, and timber also, the prices for those commodities are skyrocketing currently, which is very indicative of inflation. And so the story this week is that fear of inflation is what spooked the market. And again, I'll talk more about that in a second here. And so to give you some more context around these new trades, let's go into my X Strangle here. And so for this trade, I sold the 36 strike call option and also the 24 strike put option in the June expiration cycle. So let's go to the charts here and take a look at the charts for US Steel. And I apologize, I do have a lot going on this chart right here. I've got some alerts and some other indicators showing where some of my orders are going to get executed. So do try and ignore all of this stuff here. And perhaps if I zoom in a little bit, it might make it a bit more clear. So again, I sold the 24 strike put option, which is right here. And I was careful to put this strike below the 20 period moving average, which is this blue line right here, because oftentimes moving averages do act as support, right? You can see that happening around this zone, right here again, not so much in here, but definitely right here. And perhaps again, as X is currently selling off, the 20 period might once again act as support somewhere in this area, somewhere around $24.76. But of course, we'll see. And then on the call side, I sold the 36 strike call option, which is way up here. And I was also careful to sell this call option pretty far away from the current stock price because this stock is in an uptrend at the moment. So the strangle I put on in US Steel is basically a bullish skewed strangle. As I saw X coming down, I wanted to take advantage of that by selling a put option pretty close to the stock price. Again, because I do like to be contrarian. I do like to get bullish on stocks when stocks are going down. But also taking into account this uptrend here, again, that's why I sold my call option pretty far away. And also, one more thing, this was the spike in implied volatility that I also wanted to take advantage of, right? As an option seller, the main, most important thing of my strategy is looking and waiting for spikes in implied volatility, and therefore spikes in the prices of options. And so far so good, because now implied volatility is starting to contract and go back down, which reduces the prices of options. And so for me, if I can sell options when the prices are very high and then buy them back when the prices have fallen, then of course I make the difference as profit. That's how this works. Now let's come back to the monitor tab. And so now for my FCX trade, for this one I sold the 50 strike call option and the 39 strike put option. So let's come back to the charts and go to FCX now. And again, I apologize, try to ignore all this stuff here. So let's zoom in. So this is a very similar trade to my US Steel Strangle. This is once again a bullish skewed strangle. So I did try to place my put strike pretty close to where the current stock price is. So right now FCX is just under 42 bucks per share. My short put strike is at 39 bucks per share, just below the 20 period moving average. So same thing here. I'm hoping that if FCX does continue to come down, that the 20 period moving average will once again act as support, just like it did around this zone, right here, and a few other places as well. But of course, it does not always work, right? Support only acts as support until it fails. But I have found in my experience that relying on the 20 period moving average as a support or resistance point does work in my favor more oftentimes than it does not. And then in regards to my call option, very similar to my US Steel Strangle, I made sure to place that call option pretty far away from the current stock price, so that if FCX continues to move higher, I do give myself quite a bit of room. And both of these trades, both of these strangles, I sold for about 350 bucks each in credit. And to do so, I had to sell 2 contracts, 2 calls and 2 puts, both for FCX and also for X. Right, you can see under quantity, I sold 2 call options and 2 put options for both trades. And given that I shoot for about 50% of that total credit as my profit target, I'm therefore looking for about 175 bucks in profit on each of these trades. So that covers US Steel and FCX. And I'll briefly mention my Snapchat trade, which I've had on for a little while. And today I am making some money back. And overall, this trade is still profitable at the moment. So for now, I'll just keep it on. Nothing to do here. And I did also forget to mention, I do have a strangle on in Palantir, PLTR. And this was also an earnings play. And so far, as you can see, this one is doing very well. I'm currently up about 123 bucks on this trade after only a few days. So very quickly, let's come over to my Palantir charts, PLTR. And first thing you might notice, the implied volatility chart is missing for Palantir, and I'll talk about that in a second. And so for this trade, for this strangle, I sold the 15 strike put option, which is right down here, plenty of room to the downside. And I sold the 22 strike call option right around here. And so this is actually a bearish skewed strangle. And I made sure to choose the strike of my call option here just above the base of this little range right here. For a while, for the past few months, Palantir was range bound, and the support or the base of this range was right around $21 and call it 25 cents or so. And my thought process here is that this level will now act as resistance if Palantir can manage to rally back up to that point. And also you have the 20 period moving average coming down, which can also act as resistance. So of course, we'll see if I'm right or if I'm wrong, but Palantir is definitely going to have to cut through some pretty heavy resistance just to get up to and test my short call strike at 22 bucks per share. And so that covers my Palantir trade that I placed earlier this week. And now touching on the IV chart down here, which is missing, that's just because there is not enough data. Palantir has not been around long enough for the IV rank chart to actually display down here. That being said, you can add just the plain implied volatility chart that comes built in with the thinkorswim platform. So for example, I can go to studies and then edit studies. And in this text box, type in IMP, implied volatility, add selected, OK. And now down here, it adds the built-in implied volatility chart. So this just shows you the implied volatility and nothing else. Whereas the chart I normally use, and just as an example, let's come back to X so you can see, right, this one in the middle, and I'll expand this up. This is the one I normally use because, yes, it does show you the implied volatility, right? These two charts are basically the same. But in this one at least, you also see the IV rank and the IV percentile, which tell you relatively how high or low implied volatility is for US Steel. And that's very, very important to know. But once again, you do need a full year's worth of data for this chart to actually show properly. So coming back to Palantir now, I was a little bit blind selling this strangle, putting on this trade, but I still noticed this spike in implied volatility leading up to the earnings announcement, and I still wanted to take advantage of that. And so far, it's been working really well, because once those figures came out, implied volatility has been absolutely getting annihilated. And also, the stock really has not gone anywhere. It had a big update after those earnings came out, which you can see in this big green bar right here. But ever since then, it's been slowly selling off, and now it's just going sideways. So basically a non-move combined with a crush in implied volatility, and that's why, coming back to the monitor tab, that's why this trade is so profitable after just a few days. And finally here, I do want to touch on my SFIX trade as well, which is the one trade here so far that is definitely giving me a hard time. If I expand this tab, you can now see I am short both the 40 strike put option and also now the 50 strike call option. Initially, I just sold this put option naked. I was purely bullish on this stock, but this whole week, SFIX has been bouncing around $40 per share. And for those of you who don't know, the way I currently deal with losing positions, specifically when my strikes get breached by the stock, I either buy or short shares of that stock to cover the naked options. So in the case of my 40 strike put option here, whenever my strike gets breached, I short 100 shares of SFIX. And therefore, I turn my naked put option into a covered put option. So at that point, if SFIX continues to go lower, down to 35, down to 30, down to 20, whatever it may be, I am fully covered on this short put option, and I can still walk away by the expiration date with the full profit I was targeting initially. The one downside to this approach, though, is if SFIX breaches my put strike, goes below 40, and then it bounces back above 40, at that point I have to buy those shares back, remove that hedge position, and do so for a loss, although it's a small loss, typically around 40 to 50 bucks every time that happens. And like I said, this week, SFIX has been repeatedly going through 40 and then bouncing back above over and over again. And as a result, I have currently lost over $300 from having to repeatedly short and then buy back the shares. Now that being said, this trade could still, by the expiration date, end up as a full winner. Because by selling this call option to take in additional credit on this position, my total credit on this trade so far is almost $530. So at this point, if SFIX continues to just bounce around between 40 and 50 by the expiration date, then both these options will expire worthless. And let me actually pull up the calculator here to make this more clear. So if my total credit on this position is about $530, and so far I've lost about $320 from having to repeatedly hedge the stock, that leaves me left over $210 in credit. So like I was saying, if SFIX continues to bounce around between 40 and 50, then by the expiration date, both the call option and the put option will expire worthless, and I'll still walk away with $210. Or if SFIX skyrockets and blows through my call strike at 50, then at that point I'll just buy the shares to cover this short naked call option, and perhaps if it stays above 50 by the expiration date, again I'll still walk away with the $210 profit. And same thing if SFIX tanks and blows through my put strike, in which case I'll short the shares once again, and if it stays below 40 by the expiration date, once again, same thing, I'll still keep the $210. The only way I'll lose money on this trade is if SFIX continues to bounce around either $40 per share or $50 per share. And if that happens, there are still more adjustments I can make to this trade to take in more and more credit to continue to offset those losses from having to buy and sell the stock. So like I said, this trade is definitely annoying me at the moment, but there's still a very strong possibility that I could make my full profit on this trade by the expiration date. So we'll see. There's still plenty of time between now and June 18th, the actual expiration day. And also SFIX does have earnings on June 7th. And so that could definitely complicate things a bit further, which is also why I'm kind of regretting putting on this trade in the first place. But at this point, I don't really have a choice. I'm going to stay in this trade and fight the stock as much as I can. And hopefully by June 18th, I'll still have enough total credit to allow me to walk away with some sort of profit. And so I believe that covers the portfolio update. And so far, today is definitely a very good day. We are currently up about $263. And most of this is just making money back from the explosion of implied volatility that we saw earlier this week. So now if I come to the charts, and let me actually remove this implied volatility chart down here. There we go. And so first, I want to look at the VIX futures contracts, because this right here is what I'm talking about this week. If you were paying attention to the market at all this week, I'm sure you noticed that there were some pretty big sell-offs across the board, both in the S&Ps, the NASDAQ, the Dow, the Russell 2000, etc. Across the board, stocks, and in particular tech stocks, were getting absolutely hammered. And when that happens, I would say almost 100% of the time, you will see a pretty large spike in implied volatility. Right? For those of you who don't know, the VIX futures contracts will show you the implied volatility for the S&P 500. So in other words, this is basically a measurement tool that will show you the level of fear in the market. The higher the implied volatility, the more fear there is. And as a result, the prices of options get bid up. Right? When people get scared, they oftentimes buy options to protect their stock positions. Usually it's buying put options. And so that influx of buying, that influx of demand for options is what causes the implied volatility to spike, and therefore that causes the prices of those options to also spike. So it's moments like this, and also right here especially, it's these large spikes in implied volatility, these spikes in fear in the market, that are very advantageous for option sellers. And so this also kind of feeds into my contrarian-based approach to options trading. I like taking the opposite side of trades, going against the herd essentially. So when the market sells off pretty hard and everyone's getting scared and buying options, that's when I get excited and I start selling options, taking the opposite side of the trades. Because way more often than not, when you see an initial spike in implied volatility, very soon thereafter, it comes back down. You can see it here, back down, spike, back down, spike, way back down, and once again, big spike, boom, right back down. Fear in the market is often short-lived, and unfortunately for the people buying options during the spike in implied volatility, all those people are now losing money, especially if they bought put options, because today the market is up by a very significant amount, and that by itself hurts people who bought put options, and then combined with that, you have a crush of implied volatility, which hurts anybody who bought options, either put options or call options. And then on the flip side, as option sellers, we are all making money during this time, which is why, as you just saw, this portfolio here is up by a pretty significant amount today, and also yesterday as well. Right, so far, we've had 2 back-to-back days of implied volatility getting absolutely crushed. And so next, let's come over to the SPY charts, and I'll zoom in here. Right, so this was the sell-off that we saw this week. It definitely wasn't huge by any means, but it was definitely pretty quick. We went from an all-time high of $422 per share on SPY down to a low of just over $403 in a matter of 3 trading days. That's pretty quick. But we'll see what's going to happen right here. This 20-period moving average, my guess, is going to act as resistance for the time being. Right, if I zoom in a little bit more, this candle right here, you can see the high of this candle just touched the 20-period moving average, and now it's coming back down. So this could be a turning point in the market, although I doubt it. If the resistance here holds, we could see the market coming back down and perhaps going even lower. Or if it punches through, then we could see the market going even higher once again. And if I were to make a bet, I would say that is going to be the outcome of this, because every time this has happened, every time the market has sold off over the past year or so, it's gotten bought right back up. Every single time. Now, one time it will fail. At some point, this market, in my opinion, is going to actually come down in a significant way. Right? In my view, this kind of uptrend is not going to last forever, but we'll just have to wait and see. Now, finally, in terms of putting on new positions today, I don't really expect to do so because I currently have on 5 different positions, which worst case scenario, if I had to hedge all these positions at the same time by either buying or shorting shares of stock, and you should always plan for the worst case scenario, well, in that case, I would have to use a significant portion of my available capital to do that. But that being said, I'll still come over to the Market Watch tab here and just take a look to see if I can find anything, maybe something small that I can still put on. So I'm going to pause the video here and take a look at this list, and then I'll come back once I have or have not found anything new to trade. Okay, so I'm back here, and the only stock that I could find which could be a great trade, if I come over to the charts now, would be Seagate Technology. The ticker symbol for this is STX. And as you can see down here with the IV chart, The IV rank is at 65%, and the IV percentile is almost at 100%. So the implied volatility for this stock is definitely very high relative to where it usually is over the past 1 year. The only issue for me right now is that this stock is pretty expensive. Right now it's at $93.57. So if I were to sell options on this stock, and I am thinking about selling a strangle, I might want to sell the 100 strike call option and perhaps the 85 or 80 strike put option, which means if Seagate breaches one of my strikes, especially on the call side at $100 per share, at that point I'm going to have to buy the stock to hedge to cover that short call option. And buying 100 shares of a $100 stock is going to cost $10,000. Now this is a margin account, so in reality it would only cost $5,000, and I'm totally fine with that. But given that I currently have on 5 other positions, which like I said, in the worst case scenario, if I had to hedge all these positions at the same time, I would be using a significant portion of my total capital. And adding a whole new position to my existing ones here on a pretty expensive stock is not something I want to do at the moment. But perhaps if my Palantir strangle can get taken off pretty soon for profits, and I am getting pretty close to that, right? You can see here, I have my order already in place to take my profits once the value of the strangles I sold fall to $59. And currently the value of those strangles that I sold are sitting at just under $80. So like I said, if my Palantir strangles can get taken off soon, once they reach my profit target, then at that time I would definitely consider selling options on Seagate. But for the time being, I'm going to hold off on that. And also there are some more earnings trades next week that I may want to play as well. And so I want to keep some capital available for those trades too. And I believe that's going to wrap it up for today's video. I hope you enjoyed it. And please let me know your thoughts or if you've got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.